the top business stories live from the Sky News City studio. A blow for UK house building. Taylor Wimpey admits it will build fewer homes than it did last year. Skipton Building Society says its customers are riding out the challenges of higher interest rates. I'll speak to the Group Chief Executive. How generative AI could revolutionise accounting. Plus, £1 billion wiped from the value of the UK's biggest wealth manager, St James's Place, as its shares crash by more than 32%. Good morning, this is Business Live with me, Ian King. Taylor Wimpey admitted today it will build fewer homes than it did last year. The UK's biggest house builder by stock market value said it expects to complete between 9,500 and 10,000 homes this year, down from 10,848 in 2023 and 14,154 in 2022. Well, the news came as the company reported an underlying pre-tax profit of £473.8 million for 2023. That was down 48% on 2022. But Jenny Daly, the chief executive, said current trading was showing some encouraging signs of improvement, with reduced mortgage rates positively impacting affordability and confidence among customers. Taylor Wimpey shares currently off by 2.5%. Meanwhile, Skipton Building Society said this morning that its customers appear to be riding out the challenges of higher interest rates, with just over 2 in every 1,000 mortgage customers in arrears by 3 months or more. The UK's fourth largest building society said it had helped 19,120 first-time buyers get on the housing ladder in the last year, up 40% on 2022. Well, the news came as its parent Skipton Group, which also owns Connells, the UK's largest estate agency chain, reported a full-year pre-tax profit of £333.4 million. That was up 12% on 2022. Well, joining me now is Stuart Hare. He is the chief executive of the Skipton Group. Stuart, welcome to you. I mean, interest rates haven't moved since August of last year, and the next move is expected to be down. Are you seeing positivity among mortgage customers right now?
We're seeing positivity in the housing market generally. Since the start of the year, we've seen sales, we've seen viewings through the estate agency, all up over 10%. So we certainly see that there's a positive sentiment, but it's early days for the year.
I mean, you grew your mortgage market share last year. There's been a price war over the first couple of months of this year. Are you still actively seeking share?
Yeah, look, we don't compete on price. What we do is we want to help first-time buyers. Now, we're competitively priced, but ultimately our skill is being able to use the insights we get from the estate agency and build proposition and credit policy to help people who can afford it to find their first home.
Obviously, you see a lot of activity. You have a good view of the market through Connells as well. And I note in the statement today, you think there are more properties coming onto the market.
Yeah, well, actually, it was interesting. Last year, it was 20% up on the same period in 2022, and that's further accelerated in January. What we've also seen early on this year is demand returning. So that's supply, but we're seeing demand as people are coping with the slightly higher interest rates, albeit they're moderating. Then we're actually seeing people wanting to go and buy the houses that are available. So it's becoming a bit more of a vibrant housing market, certainly in the short term.
It felt as though there was a bit of a mismatch last year between what people were prepared to pay and what sellers were looking to raise. Is that gap narrowing?
Yeah, again, demand's coming back in. We actually monitor the ratio of asking price to that which they get an offer. And we've never seen it as high. It's sitting at 99.1, so it's almost 1-for-1 off asking price to offer price, and that's stabilising pricing.
What are you expecting to see in the housing market this year apropos prices?
I think stability. I think everything about the housing market, it works well when there's stability of economic policy, stability around prices, so that people can get used to the circumstances and then plan accordingly. I think what's important as well, though, in the medium term is we need more houses. You referenced Taylor Wimpey reducing the number of houses this year. Ultimately, we need to get the planning system, both central government and local government, working together to be able to create more houses in places where people want to live.
Do you have any optimism of that happening in the near future?
It certainly seems to be recognised by the political parties that this is an area that needs to improve. And so I am optimistic that over the medium term, we will start to see some progress.
Now, on the savings front, you grew your share of the savings market last year as well. What are you seeing in terms of people's propensity to save right now? Obviously, it's been a very tough environment for a great number of people over the last 12, 18 months.
That's right. I think the power of our mutual model here, where we don't have shareholders or investors, we are owned by our customers, is really coming to the fore, because we've been able to pass on 75% of the base rate rises in 2023. And that's meant that we're growing because customers need income from their savings in these higher interest rate times where inflation is high. And we've been able to give them that, and that's supported our growth, and indeed our growth in our membership overall of over 8%, and our deposit growth, our savings growth of 15%. So people are looking for value, but they're also looking for advice. It's difficult in this country to get financial advice unless you're very wealthy. So we want to be able to provide a proposition there as well for our members.
OK, Stuart, we have to leave it there. Good to talk to you again this morning. Nice to see you. Thank you.
Take care, Ian.
Some other business news stories for you now, and there are a lot of profits warnings around today. Shares of St James's Place have crashed by more than 32%, hitting their lowest level in 11 years after the wealth manager set aside £426 million to make potential refunds to clients and slashed its dividend. St James's Place admitted it had seen a significant increase in customer complaints, particularly in the latter half of 2023, mostly linked to client service. It also said a change to its fee structure introduced last year meant its profits growth would be lower in coming years, hitting its ability to invest in the business. Well, the provision meant St James's Place reported a pre-tax loss of £4.5 million for 2023. That was down from a profit of £503.9 million in 2022. And shares of Reckitt have slumped by more than 10% this morning after the household goods giant unexpectedly suffered a drop in sales during the final 3 months of last year. Reckitt, whose brands include Dettol, Harpic, Nurofen, Durex and Cillit Bang, admitted that the 1.2% reverse in like-for-like sales was unsatisfactory and partly reflected issues in 2 of its Middle Eastern markets, as well as the timing of the cold and flu season. The company, whose other brands include Calgon, Clearasil and Strepsils, reported a pre-tax profit of £2.4 billion for 2023. That was down 22% on the previous year. And Vodafone confirmed this morning it's in exclusive discussions to sell its Italian business to Swisscom, Switzerland's biggest telecoms operator, for €8 billion. It said that having engaged extensively with several parties to explore market consolidation in Italy, it believed this potential transaction would deliver the best outcome. The sale would be the latest in a string of disposals by Vodafone, including the sale last October of its business in Spain for up to €5 billion. Now, the rapid rise of artificial intelligence is beginning to affect most parts of the business world. The Newcastle-based software giant Sage is launching an AI product that it says will revolutionise accounting. Sage CoPilot is designed to handle administrative and repetitive tasks and help with cash flow and invoice manager. I've been speaking with Steve Hare, he's Sage's chief executive.
Yeah, so I think, what Sage Pilot is, CoPilot is the digital assistant for small, mid-sized businesses. So what we're doing is we're bringing the power of AI to the fingertips of those small, mid-sized customers, allowing them to automate everyday tasks that slow them down, whether that be managing cash flow, chasing overdue debts, generating invoices, all of these things, delivering productivity for them so that they can really focus on running their businesses rather than doing admin.
Have you had to build this from scratch, or is it basically incorporating generative AI into the existing suite of services?
Yeah, well, we've had AI in our products, for many years, but the difference now, as you say, is it's the generative AI. It's the ability to interact in plain language. And what we've done is we've partnered with a number of organizations, including Microsoft and Amazon, leveraging off their large language models, but then making it specific to supporting small, mid-sized businesses.
And how long has it taken to develop?
Well, we've been working on it for a number of years, but the generative AI part of it over the last 6 months, and we'll be looking to launch in early April in the UK, and then bringing it to the rest of the world progressively. Well, we haven't decided. It will be chargeable. It won't be free, but you'll have to wait and see till April to see exactly how much we charge.
How extensive has the testing process been, and what have you learned from that?
Yeah, one of the key things for us is, in many ways, a lot of the digital assistants that people are looking at today are very wide, i.e., they go across the public internet looking for anything they can find. We're actually doing the opposite. Our CoPilot is very focused on the needs of small, mid-sized businesses, looking at the data that they have in their ledgers and in their systems, and the other customers and suppliers that they connect to. And then, if to the degree that it does go out to the public internet, it's going to verified sources like government websites, picking up, for example, things to do with taxation. So it's very important that our CoPilot, that you can trust that whatever it's doing for you is accurate, and whatever information it retrieves for you is accurate.
Obviously, this sounds like it's going to enhance efficiency and productivity at small, medium-sized businesses. I mean, the flip side to that for some people will be presumably they lose their jobs.
Yeah, the way we look at it is we're automating the workflows and the activities which are very repetitive. When I talk to customers, every single small, mid-sized business owner I speak to says they're struggling to hire. If you look at productivity in the UK, one of the things that really holds it back is actually we don't have enough people in the workforce to generate what we need. So I think, the way I see technology is what it tends to do is elevate the work of humans. It reinvents what humans are able to do. And I think nobody ever went into business to do admin. They went into business to pursue their dream. And this is going to really help unlock the productivity to allow them to do that.
Now, separately, you've just taken part in the first meeting of the UK government's AI Opportunity Forum. What were the main topics for discussion?
Yeah, well, we were talking about how we can drive adoption of AI in the UK, and there's a number of parts to that. It starts with the infrastructure. It starts with you've got to have access to broadband. You've got to have access to computing power, etc. And then it's all about doing what we're doing at Sage, which is producing the applications that customers need and making it easy for them to consume it. I mean, I always use the example when people say, well, people aren't adopting AI. If you use a smartphone, you're using AI. Smartphones have AI in them. It's just you don't buy AI, you buy the application, you buy what it does for you. And what generative AI does is it really opens up the possibility to consume in an easy way so much more of that functionality. So we were discussing, how we make sure that the UK is leading in getting its citizens to adopt that technology.
Well, last night's mixed session on Wall Street was followed by declines overnight for equities across the Asia-Pacific region. Hong Kong and China were under particular pressure after a liquidation petition was filed against the Chinese property giant Country Garden. Well, in Europe, stocks have been pretty mixed this morning. As you can see right now, only the DAX is in positive territory among the main indices in continental Europe. Talking points this morning include the French payments company Worldline. It's off 10% in Paris after an unexpected impairment in its accounts. Well, here in London, the FTSE 100 is in negative territory, currently off just under over 2/3 of 1%, 50 points down. Well, 15 of those alone have come from Reckitt, which has obviously had a shocking session so far. St James's Place, slightly smaller company, but that's clipped a further 4 points from the index. Meanwhile, Smith & Nephew, which you can see on the screen, that fell on its results yesterday, and it's off another 5% this morning. Among the gainers, there aren't too many to talk about, but Vodafone's benefiting from its Italian disposal news. The shares are up 0.5% right now. Outside the FTSE 100, HICL Infrastructure is ahead by some 3.5% on a trading update, while the property group Durant London, who we'll be hearing from later in the programme, its shares currently ahead 1% on its results. Also updating the market today is Aston Martin Lagonda, which is off 1.5%. Meanwhile, Halfords, absolute lulu of a profits warning. The shares currently off 32%. On the foreign exchange markets, well, the dollar's had a bit of a spring in its step, firmer ahead of tomorrow's US inflation data. Well, I say that, but as you can see, sterling right now, is currently off 0.25% against the greenback. The euro off by a similar amount, the pound unchanged against the single currency. Meanwhile, on the commodity markets, Brent crude, under a Bit of a downer there. That's on the news of a surge in US crude stocks. Barrel of Brent crude will currently set you back $82.96 a barrel. That's off 0.4%. Well, joining me this morning is Patrick Farrell, our old friend, of course, from Charles Stanley, where he's Chief Investment Officer. Patrick, great to see you this morning. Lots to talk about. Start with Vodafone. I mean, this was kind of out there because they had a rally yesterday. Good news?
I think it would be easier for Vodafone to get the deal done with Swisscom, as opposed to some of the other options that they had available. So from a regulator perspective, I think, and an Italian mobile usage, I think it's a much easier deal for them to get across. And hence why I think investors like it, because there's probably a little bit more certainty it goes through.
Yeah, I mean, it's all very well, though, all these sort of piecemeal disposals they've been doing. When are they actually ever going to grow the top line again?
It's very hard. It's a hard, competitive business, and it requires a lot of infrastructure. So on that front, where are they going to get the money from? It is difficult from that perspective.
Yeah, absolutely. Now, elsewhere in the FTSE, not great news from Taylor Wimpey either this morning.
Well, house builders obviously are under a lot of pressure. And I think when we look at where mortgage rates have gone, at the end of January, we had quite a bit of relief coming through for both 2-year and 5-year fixed rates. And actually coming down below 5%, that's not a bad outcome. I'm not surprised by the fact that there is a little bit more uncertainty going forward, because bond yields since the end of January have gone up about 40-odd basis points. Yeah. So that's an effective tightening in terms of some of those mortgage resets that we are likely to see around the end of February. So I think it is going to be difficult times, not to mention it is difficult to get some of this planning permission and everything to sort of cohesively get to a point where, yes, we can open up, we can build all these new homes. It's very, very difficult on that front.
Now, outside the FTSE, Halford's really quite dreadful trading update there.
Well, any company that doesn't have a AI in its name and it's focused on physical sales is finding it a little bit tough. Now, we love to blame the weather, and I think it's fairly okay in this particular case, because bad weather, not cycling, not doing anything, but it really was a poor sort of outcome. And I think a lot of British retailers are in the position where if they didn't get those Christmas sales come through, then they're really going to struggle, particularly for maybe the first half. So unless they see that really turn around, again, I'm not surprised by the fact that they come out with a little bit more of a cautious guidance, because we just don't know what the environment's going to do going forward.
Word on Aston Martin. I mean, this has been a bit of a turnaround under Lawrence Stroll.
It has been, but any company that's got that much debt is going to come under a lot of pressure. So yes, we've seen some pretty average performance coming through from Aston Martin. Not the cars, just the share price. So I do think, though, that if they do announce something a little bit more positive on their debt restructuring, it could be a bit of a game changer. But we know that where interest rates are at the moment, any company that's got that much debt is going to come under still a lot of question, a lot of uncertainty, and it puts much more onus on the fact that they've got to sell these cars. And hopefully the 2024 Vantage series comes out and it starts to sort of blow the lights out.
You never know. Patrick, got to leave it there. Good to see you as ever.
Thanks very much, Ian. Cheers.
Still to come here on Business Live, the office giant Durant London says commercial property values could have bottomed out. I'll be speaking next to the Chief Executive. Stay with us.
They've pushed the protesters further back here. There's around 200 or 300 still remaining.
I'm Dan Whitehead and I'm Sky News' West of England correspondent.
This van goes onto the streets of Plymouth
7 days a week, 365 days a year.
These facilities at the moment are a lifesaver. It's all we've got.
From fishing communities to bustling cities, we spend every day reporting from across the region, hearing from people who have real stories.
I'm going to have nowhere to live for about 3 or 4 months.
There are still people inside the properties here. They're coming from the epicentre of what is now a global health pandemic. We were seeing and speaking to young women who were selling themselves right on the high street. It was desperately sad, and the fact it was happening right in the heart of this community. Before Brexit, these oysters were being exported to the EU, but the trade stopped overnight. What's your feeling about the future then?
Bleak. Might all be finished, I don't know.
Slightly minutes, slight better. Fly Emirates, fly better. Thank you.
Welcome back. The property company Durant London said this morning that the recent downturn in commercial property values could be coming to an end. The company, which with 66 properties is the capital's biggest specialist provider of office space, said it believed valuations were now approaching this cycle's lows after the value of its properties fell by a further 10.6% in 2023. Well, earnings for the year came in at £114.5 million, down 4% on 2022. With me now is Paul Williams. He's Chief Executive of Durant London. Paul, good to see you again this morning. What gives you confidence that valuations are reaching the bottom of the cycle?
Well, I think we're feeling things are very much stabilising. Obviously, as you said, our values were down last year, but our better buildings outperformed. Our developments were actually up. I think there's a lot of investment looking to come into London. London itself, obviously, is looking to have some population growth. It's got also employment growth. And I think the rental story for our portfolio in our locations is very good. We upgraded our guidance for rents this year. We did 3 times the lettings last year that we did the previous year. Others are reporting the same thing So demand for good quality offices, for green offices, is very strong. And I think we've had, 18 months of declines. And I think we're now seeing some opportunities come our way to look at things, the strength of the balance sheet. And I think we're seeing some good inquiries. So I think we're close to the bottom, put it that way. And I think there's an opportunity to see things improve. Obviously, we're looking for the bank rates to be cut, hopefully in the summer. But with inflation declining and coming down, we're feeling positive.
Well, it's good to hear. Last year was a very busy year for you, as you say, lettings-wise. How has this year begun?
It's begun very well, actually. We have a lot of interesting inquiries. We've just bought about 4 million already of income this year, either let or under offer. And we've got very good inquiries, not only for our standard property, but also for our developments. We've got 2 developments in the West End of London, which is a sort of prime location, and they've got strong demand. Occupiers really want to be in good locations, in quality space. So we've started off very positively again off the back of a good year last year. And again, we're feeling pretty positive, hence the upgrade in guidance.
Very striking in the statement. You do point out, vacancy rates in the West End are significantly lower than they are here in the city or indeed in Docklands.
Yes, I think we're seeing sort of what we call a re-centralisation. I think the West End has some interesting dynamics. Planning is more constrained there, lots of listed building and conservation areas, so less tall buildings. And supply is obviously a lot less than maybe in Docklands or in the city. So West End's vacancy rate is in line with its long-term average, whereas the Docklands and obviously the city is above. And I think people want to be in good locations, close to theatres, restaurants, Oxford Street and the like. So I think West End has some benefits.
What about the whole working from home debate? Where do you think we are right now on that one?
Well, I think more and more companies are saying to us and to others that, they want the majority of their time to be in the office. We have a whole diverse range of occupiers in our portfolio and in London. And I think it's seen as a strategic asset. So I know that occupiers are now looking long-term at their strategic needs. And I think London has a benefit of being a global city, being very, very diverse. So I think, Fridays may be quieter, but Monday through to Thursday are busy across our portfolio. And I think people back enjoying being together. I think there's a productivity benefit of being in together. There's a collaboration benefit. And I think there's also a mental well-being benefit of being amongst your mates and working together.
Yeah, completely agreed. Now, what about you? Spent £169 million last year on development. Are you seeing inflation still a factor in development?
It was high last year, definitely. We've seen it come down quite materially. We're in a good place. We do a lot of repeat work, so we're able to fix our costs. But we think it's come down quite substantially, probably 2 or 3%, something in that order. We always want our contractors to make some money as well, because I think we want to pass that through the supply chain. So we think it's very much under control after a year of quite high inflation.
OK, Paul, we've got to leave it there. No, busy day for your results day. We do appreciate you sparing the time to chat. Thanks for joining me.
Take care.
That's it from me. I'll be back at 4:30 with our afternoon edition. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, Jane Secker is going to be here with Prime Minister's questions, and she'll be joined by Beth Rigby. Don't go anywhere. I'll see you later on. Cheerio.